Hey, what's up, best ever listeners? This is John Casman, and we are here with Multifamily Mastery, and I'm really excited for today's guest. We are here with Jeff Niemeier. Jeff, how are you today?
Hey, outstanding. How about yourself?
I'm well. Listen, Jeff has a lot of great insights, and we're going to have some great conversation with Jeff. Jeff is also a podcast host. He's got a show called Student of Money, and he also is a real estate investor with his JB Capital Fund. Jeff, why don't you take a minute and talk to our listeners a little bit about your background and experience?
You bet. My name is Jeff Niemeier. I am the host of the Student of Money podcast, as well as a real estate syndicator and a fund manager. I'm the managing principal of JB Capital, which is a vertically integrated private equity real estate firm that specializes in build-to-rent townhomes in the Midwest.
I love it, man. I love it. So we're going to talk a lot about that space because build to rent is certainly something that exploded onto the scene not that long ago. I feel like over the last, 5 or 6 years, it really grew in popularity, whereas we didn't see or hear as much about it. From your standpoint, like, why did BTR grow as much as it did?
Yeah, great question. I started out buying,
and we should say again, right? BTR, of course, is build to rent. So maybe we should start by explaining what BTR is and then getting into why it exploded.
And really, it's been around a really long time. I had a guy on my podcast named Daryl High from High Properties in Cedar Rapids, and he has always done build to rent, and he's about my age. And he started out in 1988, and again, same age, but he did build to rent the whole time. And so it's been around forever. People do it, but really, like you said, in the last 5 years, as these interest rates ticked up, people have really kind of switched to it and looked at it. And I think it's really because of the interest rates and because of what's going on in the market. Because before, real estate syndicators had this thing where you could buy a property and you could just hold it for 18 months, do nothing to it, and it would go up in value. And you could turn around and exit out and kick that waterfall model in. And so the sponsor gets paid, right? And so a typical hold period would be 5 to 7 years. And I used to buy pre-existing. I actually cut my teeth in student housing, got pretty large in student housing, and then decided to go into workforce development. But what really got me going with the build to rent model is I got tired of buying 20-year-old properties that had a lot of issues that you really don't know about, because the reality is no one's selling a property because it's making them a lot of money. There's a problem. And it could just be time for them to exit out. They could be fully depreciated out. They could have had the owner pass. They might have had a partner who wanted to exit out. There might be something, but for the most part, people are buying or selling properties because they have problems. And if you don't know what those are and you're like, oh, I bought this thing at a great price, until 6 months down the road, you find an issue that you really didn't know about and it wasn't disclosed. Maybe it's a foundation issue. Maybe in the wintertime, they heave a lot. You could have tree roots growing into the sewers. You got to, fix those every year. There could be a lot of issues, or the vacancy could just be bad. In the student housing, in the sector I was in, I was by a community college. And funny thing about two-year community colleges is enrollment is the opposite of how the economy's doing. So when the economy's bad, the occupancy was way up because everybody's going back to school and getting trained up. And then the opposite, when the economy's doing really good, enrollment really starts to drop, and then you start getting higher vacancies. So, and then it got overbuilt. And then there was issues with just too many people overbuilding in an area. So ultimately, one of the things that drove me to build to rent was that you get to pick the location of the property. You get to build brand new, so it has a much longer life, and you get to control it from the entire process. Because one of the things I really love about real estate is your ability to control the project and your ability to control your income. So, if I buy a stock, say I buy the NVIDIA or I buy Microsoft or Apple, there's nothing I can do to affect the price of that stock. I just assume that it's going to go up over time. But with real estate, you have much more control. You know what the formula is, the magic formula. You can increase the income and decrease the expenses, which is that NOI, your net operating income. And then you take a look at what's the market going to give you on a cap rate for financing. And then what's comps, what's things selling. So you have a lot more control with real estate than you do with any other asset class.
Yeah, you hit on a couple things, right? For you, it sounds like you were investing in more these towns where there's community colleges, right? And you were investing, but recognizing that you were kind of tied to the patterns of the economy, right? The economy goes up, enrollment kind of goes down. The economy goes down, enrollment goes up. And you wanted more control. And that's one of the reasons I think people love real estate in general, especially commercial real estate, is the control, the ability to force appreciation, the ability to have a business plan, implement that business plan, and drive value that way. You also talked about, buying 20, 25-year-old apartments, but not recognizing what some of those issues or the underlying issues may be. Maybe it's a partnership issue. Maybe it's a property issue, right? So you're just trying to understand what is it exactly that you're buying, because people sell for a reason and you have to understand what that reason is. When you looked at BTR, build to rent, as opposed to apartments or value add apartments, which is kind of where most of our listeners are playing, what was it about build to rent that was attractive versus, say, established apartments?
Well, you get to control, again, going back to control, you get to control it from the very beginning. I think a lot of people get scared away with development because they've never done it, right? You haven't built anything before. And the reality is one of my very first properties, my very first rental property was actually a build property. It was a 4-bedroom house. Back in 2006, I bought an empty lot that some developer was building a house on. We knew it was going to be student housing, so we knew what the build quality was going to be student housing. We've got houses right next to it that have students, and I actually rented that to 4 students, and I just went to them with the plans for the house, said it'll be done by August 1st, and then I had them sign a lease. They gave me their security deposit. One of the moms says, "Hey, do you mind if I pay for Johnny's rent for the entire year all up front?" And I'm like, "No, not a problem. If you want to pay, so these are all the way." So then I went to the bank to get financing. I says, "Here's a purchase agreement for an empty lot. The developer says he's going to build this house. And by the way, I've already got it rented. Here's a copy of the lease with the 4 people, their security deposit. Johnny's mom paid for the entire year all up front. So I got that money." So I was able to go in there pretty much. At that time, back in 2006, I had an 80% first position loan, and I got a 10% second position loan from the same bank, which you could do back in 2006, and that would never happen today. So I really only had to put down 10% on a $125,000 house, and I already had, say, $10,000 of that from security deposit, which you're not supposed to use, but I did back then, as well as Johnny's first full year of school already paid for. So I think I pretty much bought that property with like $2,000 on my credit card. It was my first rental property that I still own today. I used a credit card. And I really didn't want to do it. But when the bank did the drive-by, like the day before the close or the week before, I got a call from the banker and says, "Yeah, hey, I drove by your house. You don't have a lawn. You have a dirt." And I'm like, "Yeah, but the house is done." And they're like, "We're not closing until you finish your landscaping." And I'm like, "I don't have the money to finish the landscaping. I'll do it after we close," was my thought. But they called me on it. And I'm like, uh-oh, I got to do something. So I ended up, hiring a guy to come out and put the lawn in and put it all on a credit card, and so that we could close. And I think within the city too, the city requires 1 tree. Right. So you got to have 1 tree in your house, and you have to have grass. And even though the house was done, and I was just I was pinching pennies. I didn't have a whole lot of money back then. And, I found a way to make the deal work. And again, back then I could do an 80% first position, and the bank would do a 10% second position. And then I was able to finance the rest of it. So we kind of put some money together to buy that first rental. And that rental, I remember talking to my wife and saying, my son was like 3 years old or something like that. I says, "This house is going to put my son through college." That's what I told my wife. And in an amazing way, it has. That rental house, along with all of my other rental properties, put both of my kids through college. So those are just examples of kind of how you got to have to get creative when you're early on and you're trying to put stuff together, and you just have to find a way to make it happen. So that's what we did. I forget the original question. I don't know if that answers.
Jeff, I love the creativity, right? You talked about this development deal, $125,000, 80% coming from the bank, another 10% second position loan. You took the security deposit and some credit cards to pay for the rest. So basically you did this with really no cash, right? Very, very little cash.
Yeah, it was a no money down deal.
You had no money down development deal, right? I've heard of that for existing assets or flip projects, but not really a development deal. So that was definitely a unique strategy and approach to take. And the question was about, BTR versus buying existing assets. But I want to ask this because you said most people are scared of development, and that's true. Yes. Because there's so many unknowns. And I would tell you that, developments inherently provide more risk than existing assets simply from the fact that one property is physically there and one is an idea and a vision, and there's a process to make that come to fruition. So for those folks who are interested in development but scared for those reasons, talk to us about your belief and maybe how you minimize or mitigate some of those risks.
So what I did is I partnered with a builder, right? So like in that first house, I hired the builder, or the builder he was already the general contractor. He was already doing the building. I just had to put my faith in him. Was he in
place when you found him, or how did that come to be, right? Because you just drive around and find a guy, or was he already building in that community?
Well, back in 2006, when I bought that first house, I was already looking at that street, and I could see it was a cul-de-sac, right? So there's 13 houses around this cul-de-sac, and they're all being built as student housing. And there were 3 or 4 investors that were doing that. And there was a couple empty lots. And of course, there was for sale signs in there. So I just called them, and it's like, we're just, my brother and me, we're building these 2 houses. And I said, I want one of them. So we negotiated a price, and I just said, hey, you just, it's going to be done by my biggest fear. And the biggest thing is the thing had to be done by August 1st, because we have students moving in. And that's a leap of faith that, hey, because this was like March, that these guys are going to get this thing done in 4 months, 5 months, whatever it may be. And they promised me they would get it done, and they did get it done. But so then when I'm looking at it now, and I'm saying I need to do new construction, I talked to several people that are in the build to rent, and I've interviewed multiple of them, and they have convinced me this is the way to go, through control, through being able to stretch things out over a longer period of time. If I sign a purchase agreement to buy a property, whether it's single family or a 200 unit multifamily, you typically have 45, 60, maybe 90 days to close, or you're going to lose that deal. Especially as a syndicator, where you then have to go out and raise that capital. If you can't raise that capital, you'll lose the deal. Way different on build to rent, because now I can build out in phases. I am simply building out residential fourplexes to scale. So that means I no longer have this 45-day, 60-day, 90-day window. I now have a 2-year window. I am raising capital as I'm building, but I have never built before. So how do I overcome that fear? Is I partner with somebody that's 30 years as a builder. And it's somebody I knew, somebody I trusted, somebody I was in the military with. I know their work ethic. I know who they are. And he came to me actually from listening to my podcast 2 years ago and said, I need to make a change. I've been a builder for someone else for the last 30 years, but I don't have any rental properties of my own. I don't have any wealth. I don't have any. So he brought a skill set to the table that I was looking for. And then I brought obviously my skill set. So his name's Matthew Hale. You'll never see him on any of our, he's on the website. He's got his picture, but he's not comfortable being in front of the camera. So I'm the in front of the camera guy. I'm the one that goes out and raises the capital. We find the properties. I turn it over to him. We do the development, and we do the general contracting. And of course, we're talking to other general contractors as well. So if we get into a really big project, there's lots of people that want to partner us with us now. We have general contractors wanting to have lunch with us, talk about what we're doing, where we're going. And, I'm like, you know what? We're good right now because, I would have to pay for a general contractor, but I would rather take those fees ourselves because with our model, with our fund model, we have very low fees. We don't have acquisition fees. We don't have disposition fees. We don't have refinancing fees. We basically have a developer fee, a general contracting fee, and a property management fee, and that's it. So there's no other fees. We don't fee people to death like a typical syndication would do. So we found a model that works. And to answer your question, to get over that fear, you partner with somebody. So if you're weak in something, partner with somebody.
And Jeff, I really appreciate the context and the examples because, I think people intuitively know that, but to break it down like you did really helps to give context because on that first deal, right, we're not talking rocket science. What you did here, and I think this is a really great insight, you identified where developers were already developing, right? They were already on that street. You already knew the area. You knew it was going to be a great place to own. And you just went to them knowing that there were lots available and said, hey, listen, can I get one of these lots? You guys will develop it. Can I get in this time frame? And from there, you can build out the rest of your business plan, right? So you partner with them in that area. And then as you scaled over to new construction, build to rent, you took a similar approach, but you had this relationship with this contractor. He had that experience and came to you. He recognized that, I've been doing this for 30 years, but I don't have equity out of the projects. And it's interesting. I had a coaching client, Justin Smith, shout out to Justin. And Justin came to me with a very similar thing because he had been in construction and built, massive projects and his company is Real Equity. And what he talked about was, I can feel good about the work I've done. I can show you awards that I've won, but I don't have equity in these projects, and that was something that I know he was adamant on is so many professionals in the space, whether you're an architect, whether you are a contractor, plumber, whatever, you're in the space, you know how the real estate works. You know how to build it. You know how to do the thing, but you're getting compensated off of the job or off of the project, but not through equity. So for him to recognize that and to partner up with you, that is a win-win situation where now you can leverage his experience and his knowledge on taking on that space. And he can leverage the stuff you're doing, being the face of it, raising capital, building a brand and all those things. And that's a great way to grow and scale. You mentioned too that this is a guy you had been in the military with, you've known for, 30 years, I believe you said. So you have a long history with this individual. Did he know this is what you were doing, or did he find out kind of through the podcast or some other means?
Yeah, good question. So I was in the Marine Corps for 13 years, 88 through 2001, right before the towers fell, and got out in the reserves. I was in the reserves, to clarify. And so he was in the reserves with me as well. He went a full 20, was deployed to Iraq twice and Afghanistan, and went all the way up to first sergeant in the reserves. And so, when you get out of the reserves, we kind of lost touch with some of those people and even though we live in the same city. So, it probably had been since 2001 since I really had seen him last. So he just, through social media, through Facebook, through LinkedIn, saw my posts, because I've really gotten more of a social media presence as a capital raiser probably since 2022. I started the podcast shortly after that. Basically, I started selling off my student housing properties in 2018, 2019, and actually sold my very last student housing property in February of 2020, right before COVID. And then I actually went to vacation down in Cancun. And I'm sitting on the beach in Playa del Carmen during COVID, while COVID's hitting the States. And everybody's texting me and calling me saying, you need to get home because they're shutting everything down. And I'm not hearing anything about it in Mexico. And so I'm having to watch CNN International to figure out. And we ended up flying out Saturday. And they were closing the Cancun airport on Sunday. So we got into the United States and basically everything was shut down for 2 years. So I'm trying to figure out what's my next step. And I says, I'm going to start a fund. Took the Series 65 investment advisor exam and passed that. And then I joined a couple masterminds because I wanted to know what, I could retire and do nothing, or I could continue to build from here and do something new and different because I'm very entrepreneurial and I kind of want to always do something. So I decided, I wanted to start a fund model versus a syndication. So I joined a mastermind, and the very first week of the mastermind, you have to pitch them your thesis, your investment thesis. And I was thinking back at that time, I'm going to go to Texas. I'm going to go to Florida. I'm going to go to the Sunshine Belt. Maybe I'll do a fund of funds. Maybe I'll start dabbling into property tax liens and starting to get into some other things. So I pitch my plan and they tell me, oh, no. You're not doing any of this. You're not doing any of this. What have you been doing for the last 20 years? And I said, I've been doing multifamily, student housing, and workforce in Eastern Iowa. And they says, you need to do that. No one's going to give you money to try something new that you have no experience and haven't done. You need to do what you know, what you're good at and what you've been doing. So back then I made the decision, I'm going to stay in Iowa, going to stay in Eastern Iowa and Des Moines, the two hottest markets. And I'm going to use my unfair advantage, because if I went to Texas, if I went to Florida, if I went anywhere else, I would have to what? Partner with someone from that area. I don't know the area. I don't know the politics. I don't know the city council. I don't know who the vendors are. I have no relationships with people there. So you really have to trust or partner with somebody in those areas. So on my podcast, again, I interviewed quite a few people, and the people said, I can't do what I do here in California. I can't do what I do here in other areas because, one, they don't have the cornfields and the open land. The politics is different. There's a lot of things going on in my market. Like we're getting a Google data center. QTS is putting in, a $2 billion data center, and they're going to spend $10 billion over the next 10 years. They're widening the interstates to 6 lanes. We have a nuclear power plant that they took offline like 5 years ago. They're putting in the paperwork to get it started back up again, because what's the data centers and AI all need? Power and water and all of these issues. So there's a boom going on in the communities that I'm in. And this is where I have the unfair advantage. And this is where everything points to. So I says, you know what? I'm just going to stay here in Iowa where I know the market and I have that unfair advantage. And so I totally changed my thesis. It took me a year to really digest this and go through this and try to put a team together and figure things out. So now we're ready to deploy and start to boom and, Jeff 2.0.
Yeah, there's a lot of lessons there because I think often as investors, you hear of a strategy and get excited about it and want to run off and, all right, yeah, I'm going to do this. I'm going to do that, right? Texas is hot. Florida's hot. I'm going to do this. And I remember when I was starting out, man, my mentor, Joe Fairless, he, I was trying to pick markets, right, that I was going to invest in. At the time I was living in Chicago, and I did all this research on like the best markets in the Midwest. And through all of this research, my conclusion was Madison, Wisconsin was the market I should be investing in, right? And I go to him and we're talking and he's like, why Madison? I'm like, all the research says that's the best market. Population is growing there, good taxes, all this stuff. And he's like, have you ever been to Madison? Never in my life. You have any family, friends in Madison? Nope. Do you have any desire to go to Madison? None. Maybe if Ohio State's playing them, like Wisconsin, right? Like, no. Yeah. He's like, I don't think you should do Madison. I'm like, you know what? After you ask all those questions, the answer came clear to me as well. Yes, I get that. And part of it is this, man. There's a human component to this. Where do you have an unfair advantage? and not just my goodness, not just geographically or from a demographics perspective, but think about it from your own experience. What have you done that maybe others don't know? Where have you been? What have you seen? What do you understand? And if you can figure that out, that gives you the razor's edge to be successful because you know something or you can do something that others can't. In your case, you knew Iowa. You knew what you could develop there as far as student housing. You understood, the local scene. You understood the laws. You understood why these trends were happening. You weren't just reading about them and saying, oh, okay, well, hey, population is growing here. You took it 2-3 layers deeper to understand why that's happening and whether or not it was likely to continue. And what ends up happening in a lot of places is people stay on that first level of data. They look at it and say, oh, population increased 3% here. This area is growing. But they don't go to reason 2. Well, why is it growing? And the most important question, is it likely to continue based on the information that's there? And they don't answer these questions. So, they wake up one day and the business plan isn't going as well as they thought because they never got further in their research. They didn't look to see how much new supply was coming online or what that new supply would do to demands or to rent growth and all these other factors. And that's true for any business. I worked at large businesses, large companies, and this is the same thing, right? People, they're emotional by nature. So they find some data point that justifies their decisions. They run with it and they're not really critically thinking about all the different ways things can be impacted. So you run with that. So the more knowledge you have, specifically locally, in understanding the trends, the tastes, what people are looking for, that's going to empower you to be successful. So I love your point there about the unfair advantage. I do want to come back to this point about BTR though, because one of the things that stood out to me as I started reading about the growth and demand for build to rent was we know that, we have a shortage of housing. Even with all the new supply of apartments that's come online, we still have a massive shortage of housing in this country. We also have an affordable housing crisis going on, right? The stuff that's being built is mostly luxury or it's some sort of subsidized housing. So we don't have as many affordable products being on the market. We also know that most people don't want to live in a big apartment building where they've got, 52 neighbors. So if I could have a house that feels like a home, but not be financially tied down to this thing for the next 10, 15, 20 years, that feels like the best of both worlds. So I know from my standpoint, I always feel like build to rent had that going for where I could have a house that felt like a home without the responsibilities of being a homeowner. And when you take that based on the demographic things that are happening and the trends, where again, interest rates have shot up, which makes it harder to be a homeowner in today's environment, it kind of creates an environment where it's really a best case scenario for the build to rent trend to continue to grow. That's me hypothesizing off of reading and what I see. You're actually investing in this space. How does that track with what you're seeing on your end?
Definitely, everybody would always rather live in a house versus an apartment complex, right? And in downtown Cedar Rapids, we have a lot of apartment complexes that are coming online the last 18 months that were probably deals that were done when the interest rates were lower, but there's not a whole lot of entry-level homes, single-family home. Being able to afford a house is getting more and more difficult. So the great compromise there are townhomes, right? So townhomes are the density of apartment complexes without being an apartment complex, having a garage, not having anyone below you or above you, right? So you don't want to be banging on the ceiling because people are loud. Now there's 0 lot lines to the left and right. So you've got, you've got neighbors to the left and right of you. But to me, it's the perfect compromise in this renter type nation that we have because affording the houses today, housing prices, single family housing prices have not come down. And they continue to go up and they continue to sell. When I talk to realtors, I just bought another single family rental property in Dubuque that's a college student rental. And when I talk to the realtors, houses are still moving. They're even at the prices that they're elevated at. And, I kind of operate by the 1% rule. So rent should be 1% of the purchase price. So if you buy a property for 100,000, rent should be $1,000. And it's getting very difficult to find houses that, you don't get much for 200,000. Well, even in Iowa, but definitely in other parts of the country, so housing's still somewhat affordable in Iowa, but it's still out of reach to a lot of people. And people really are becoming a renter nation, and they definitely would rather live in a townhouse versus multifamily. So I am leaning more towards townhouse communities and single family houses, and not so much in apartment complexes. And if I do an apartment complex, a lot of the student housing are 3-bedroom, 4-bedroom. You really want density, because in student housing, we talk about bedroom doors. We don't talk about number of units. We talk about beds. Because, so the denser, the better, so, I had a lot of fourplexes. Well, the transition of fourplex from student housing over to workforce or low income did not work out very well. It was a horrible thing. And we started selling those. And, so we pretty much single family houses, those are 4 bedrooms. The townhomes we're building, they're 2-bedroom, 2-bath. Might have a couple 3-bedroom, 2-bath, but the bedroom counts are lower. Whereas in student housing, you want the bedroom counts to be way higher, I guess. I don't know if that answers your question, but it's,
it sounds like
I definitely see that single family, quite honestly, the single family houses are just as profitable as the apartment complexes, if not more. And I've had this debate. I've had a couple people on my show that are focusing on single family, and they have funds where they buy 30, 40, 50 homes at a time in a portfolio. And because they don't like multifamily, and they make some really good arguments on because we asked this question, would you want 100 single family homes or do you want a 100-unit apartment complex? What would you prefer? For me,
it's definitely an apartment community.
So most people would say apartment community. I've had some very interesting people talk about, I would much rather have the 100 houses versus a 100-unit apartment complex. And I tend to be 50-50. I see the points on both, but I'll tell you, my profit margins are actually higher on my single family houses than it was in the apartment complexes, unless I was in student housing or unless I'm in some other type of, but just workforce or low income. The single family houses I've actually made much more money on, and there you have a lot more different exit strategies. You have a lot of differences in financing, just in things like Iowa landlord tenant law on pest control. On a multifamily, who's responsible for if you get a bed bug or fleas or whatever? Who's responsible? The landlord. On a single family house, who's responsible for pest control? The tenant, not the landlord. Big difference. So there's some issues out there that there's just a lot more exit strategies. And when I talk to investors, we talk to them about the townhouses that we could condoize these, sell these off individually, and we'd have a different form of exit as opposed to just looking for another multifamily investor looking to buy an apartment complex. So, it's an interesting argument, but I love to pitch that because I also have people that we've talked to, as well, who would say that, I don't like residential. I don't like multifamily. I'm going to go commercial, retail commercial. I'm going to go warehousing. I'm going to go storage centers. I'm going to go, they love those because they don't want to do toilets and, triple net leases versus, all of these issues. So the key here is specialize in something, get very focused, because when coming back to this conversation, be very focused, and that's where you're going to make the most money. When you start to get too diversified, you're not as profitable as when you start to just say, I'm really, really good at this one thing. I'll just take that and knock it out of the park.
Jeff, you hit on something really important, right? And I think the big picture here is your strategy has to be your strategy based on what you like, your market, and all the things we've talked about already. Like, just because one person likes, single family houses or one person likes apartment complexes doesn't mean that's right for you. You've got to understand the why we like what we like and then adjust. And the thing that I like about what you're talking about here with the build to rent is if you do it the right way, you could get the best of both worlds, right? Where you can build your own community. So you have the centralization that we love about an apartment community, but you also may have individual homes where you have the flexibility of either your exit options, your financing options, and things like that. Now, again, if you did build 100, you still have 100 roofs and 100 HVAC systems and all that to deal with, but they're all in one location. I think one of the things that I've listened to a number of investors talk about, especially when I was starting out, is when you build a portfolio of single family houses, typically they're going to be all over the city, right? Even if you have one side of the city, you're still going back and forth all over the city. And that can be problematic versus here in build to rent, especially if you're focused on a community. You can almost treat it like an apartment community, right? Because you can have a place where you store all your stuff and your materials, your crew can be right there, as opposed to having to drive 25 minutes to the north side to handle something and then shooting all the way to the west side. And you're wasting a lot of time, in the vehicles, as opposed to actually being on site, making a difference. Yeah.
Travel time was a big pain, and it's something that I'm very conscious of. So my cousin who got me into real estate was exactly that. He had single family houses scattered all throughout the town, and his maintenance people were crisscrossing all over. So because I got into student housing specifically at one school, I just dominated that one area. So there was 4,000 rental units for that community college. I just focused on all of my rental properties were within a half a mile. It literally was, it took me years to acquire. It's like, okay. There's a house I bought 6 years ago. I had a contract on it. I couldn't close it. So I couldn't get it. And then 6 years later, it came up for sale again magically. And I didn't even look at it. I called the realtor, put in an offer. I said, I know that house. I've seen it. I've looked at it. It just passed city inspection. It's in my neighbor. That cul-de-sac, I own half that cul-de-sac now. And I started with just one house, but over a decade, every time a house on that cul-de-sac came up, I bought it. So, I'm very focused, very hyper-focused on one market and one area. So when I went to go do some stuff, I'm not driving crisscrossing all over town. I'm on that one neighborhood. And if somebody comes out to Kirkwood Community College, 50% chance they're probably going to rent from me, because I just dominate in that market. And I just know that market so well. And so that's kind of how I built up that student housing. And if I didn't own the property, I was providing them cable TV and internet, because that was my first business. So I knew all the property managers in there. I knew it was just, I was so hyper focused on that one market. And that's how I was able to have, again, that unfair advantage. So you got to figure out what your unfair advantage is. What do you bring to the table that no one else can bring? And can you just dominate on that? Diversity is used for, my diversity is multiple streams of income, so that if one stream dries up, I've got other streams of income that I don't have to worry about. But when my one income stream, I get hyper focused on it, because that's how you become the most profitable. And then all you do is just cookie cutter stamp it and create multiple streams of that exact same thing.
Jeff, phenomenal advice and information there. You kind of dropped a little hidden nugget that I got to explore. You mentioned that you were providing cable and internet, and that was your first business. Was that kind of how you were able to, I'm going to say, infiltrate the market, or like how did you get growing there?
So I have an electrical engineering bachelor's, and my first employment was in IT. I got Microsoft MCSEs, and I'm Cisco certified, and back in the late 90s, and if you remember Y2K, I was just talking about this when the Y2K bug, I was probably the tech that came out to your computer and made sure that it was going to survive Y2K. But I got into the internet and firewalls and security and wireless. So when I left my employer, I started a wireless internet service in rural Iowa, bedroom communities around Cedar Rapids, before they had cable modems and DSL. So everybody was still doing dial-up. So I started a wireless ISP, and I was serving both houses and businesses, and I had 200 subscribers. And then every time I hooked somebody up for internet, they asked me about television. So I was partnering with a Dish Network retailer, And then I says, why am I giving him this business? I need to do commercial Dish Network. So I became a Dish Network retailer. I found out, again, Robert Kiyosaki looking for passive residential residual income, that commercial television head ends, you get a 15% residual on their cable television bill. So when you go pick up a hospitality, a hotel or a assisted living or a student housing complex that's got 500 units, and they've got a $20,000 cable television bill every month, because what do they do in student housing? Everything's included. Your electric, gas, water, cable, TV, internet. It's all inclusive in student housing. So I put in a bid and I beat out. I won the bid for a 400 unit apartment complex, 752 beds. I provided them Dish Network, cable television, and high speed internet cable modems to their units. And then I just went down the street and started hooking up more and more apartment complexes. And when I went to sign a deal with an apartment owner, Paul Gingler from Des Moines, Iowa, he had this little 16-plex in Cedar Rapids. And I said, oh, you're looking to sell. And I said, you mind if I put in an offer? Because he says, if we sign a contract, you got to renegotiate your contract. So that was my very first apartment building, because I already bought the one house. And then so I was actively looking, and he actually sold me that on contract. He sold me that 16-plex because he was a real estate investor, and he flipped houses in Des Moines, and he sold a lot of single family houses on contract. So I went to my friends and family network and I raised $65,000, and I bought $880,000 of real estate that year. What I didn't know is that what I was doing was called a real estate syndication, and I was getting into the securities business. I was no longer in real estate. I am now in securities, private placements. So in 2010, 2011, I started going to a bunch of syndication training, went to the real estate guys, syndication training, and I took the Series 65 back then as well. Had lunch with a hedge fund manager. He showed me the rule of 220, 2% assets under management, 20%. So I found out all about securities and how to basically raise capital and raise money. So, I kind of been doing that since 2010, but I started out in technology, and then I sold that cable television business to a competitor, to venture capital, essentially, in 2005. So I was an entrepreneur, business owner from 2002 to 2010 about, and then got into real estate 2006, and I've been pretty much focused on real estate. Jeff, and syndications.
Jeff, great stuff, man. And I'm glad we just talked about that, because here's a big nugget, right? We talk about our journey into mastery, and multifamily is something that you never fully master. You just always get a little bit better and you learn things here and there. And we were talking about the unfair advantage, and you just talked about it, right? You are going into these facilities, selling them internet and cable packages, right? Direct TV services. So you were a vendor, but you're having these conversations with the property managers, with the owners, and you're building these relationships. And that actually led to your first commercial deal. And we talk about the unfair advantage, and we talk about just taking action and how these things kind of stack up. And ultimately, that is how you get success. You got to just play around. Like in sports, they talk about just hanging out around the net, right? That's what this is. You may not know exactly what you're doing, but if you hang out around the goal, you probably get a rebound and put it back, or you probably get a little slap shot. Listen, this is it. You've got to be in this world. You've got to surround yourself in this space, and that creates a lot of opportunities. And that's how you were able to get going early on. I love how you talked about too, like being in Iowa, you just focused and you got to the point you said, you know what? I'm locked in on this half-mile radius, and I know these properties when they come up. I don't even have to look at them half the time, because I know exactly what's going on with that property based on its location. I've driven that street. I own properties on the street. And that is a level of an unfair advantage that allows you to stand out. And for our listeners, continue to think about your own unfair advantage. Where can you scale? Where can you stand out? If and when you need to partner, identify the right partners that allow you to continue on that journey so that you can build a portfolio that helps you live the life that you want to live. You also mentioned one other thing I wanted to highlight. And when we were talking about, kind of your journey and really getting more into the build to rent space, you mentioned that you joined a couple of masterminds. You got your Series 65 and you did all these things. And it's important to call out because I think oftentimes we talk about education, but it is so important to invest in yourself. Invest in yourself by listening to podcasts like this, by attending events, joining masterminds, getting a mentor, getting a coach, but surrounding yourself with people who can help you elevate your game. That is absolutely critical if you are serious about scaling your portfolio. And you gave a couple different examples of how you're able to do that. Like you mentioned, attending some of the events with the real estate guys and joining these different masterminds. And that's critical. So again, if you're looking for some clues or some tips to success, this is it, right? Lock in on where you want to invest. Have a very clear investing thesis. Surround yourself with professionals that can help you succeed and understand how to help you navigate through your investing thesis and ultimately stay consistent with your actions. That's going to allow you to have great success. Not to mention, you're going to have some challenges along the way, but if you stay with that, you're going to see success more often than you see failure. Do you have any last words for our listeners?
I would just recommend people take action, because not taking action costs you way more. And I've gone to events and I've talked to people that I call them groupies. They attend all the events. They pay for all the training. It's like, have you bought your first property yet? And they haven't. And I'm like, you guys need to take action. And then second, get involved in your community. Get out there, go to networking events, talk to people. I joined a couple nonprofit boards. I'm on the board of a credit union now, and it has opened so many doors to me from people in the business community and the surrounding area. So get involved. I teach junior achievement in the K through 12. So I'm out in the community, actively meeting people, giving back, and again, that personal and professional development. That's really your best investment. So you're spot on.
Jeff, absolutely love it, man. Great stuff. I love our conversation talking about not just build to rent, but how to scale your portfolio and take advantage of your unfair advantage. Hey, listeners, if you enjoyed this show, make sure you like, share, and subscribe. That's right, share it. Someone could get some value. Go ahead and send this to them so they can check it out themselves. And if you want to connect with like-minded individuals like myself, like Jeff, like other real estate professionals trying to grow and scale their portfolio, make sure you join us in February out there in Salt Lake City for the Best Ever Conference. Going to be a great time. Check it out. We'll put some information in the show notes, but check us out in February for the Best Ever Conference. Again, this is John Casmer here, host of the Multifamily Master Show with the Best Ever CRE podcast. Looking forward to seeing you next Saturday. Take care, guys.